Brian, for the introduction. For those that don't know, Ofgem is the regulator of the gas and electricity markets. The organisation is effectively split into two parts. One part is involved in the oversight of the government environmental scheme, which is the part that I work in. The other half is involved in the traditional regulatory activities, such as regulating the assets of the transmission wires, the distribution cables and so on, and also the oversight of the markets and how electricity is supplied to consumers. And obviously our principal objective is to protect the interests of consumers, and we do that by promoting competition in the gas and electricity market, but also regulating natural monopolies such as the networks. We administer a range of environmental schemes. My job is to oversee, essentially in the team which oversees the two large renewable electricity schemes that we have ongoing, the Feedin tariff and the renewable obligation. And just to put those two schemes into a bit of perspective, the renewable obligation this year is worth £2.5 billion in terms of the amount of money that's going to flow through it, and next year will be worth around £3 billion in terms of how much will be traded through it. And by comparison, the Feedin tariff scheme is considerably smaller, but is still worth around £700 million per annum. So two very large schemes. Next year probably worth nearly approaching £4 billion a year. What I've tried to do here is to give you a historical perspective on how those schemes have been performing, and to give you a little bit of an insight into the way the market has evolved. Right. Great. So this is just a brief overview on what I plan to talk about. Some of the key drivers in the renewable sector, where the change is coming from, some of the trends across the scheme, and then just to finish off with some concluding thoughts. I think the main thing when I was pulling together these slides for this presentation, I was just having a bit of a recap on where we've been, on what we've come through, and then looking forward. I mean, people talk about the uncertainty in the market and how much change is going on. From what I remember, I've been involved in the environmental scheme of place arena for Ofgem for a number of years, and almost every year there have been changes to the renewable schemes. I mean, admittedly, this change going from the RO to the contracts for difference is a very fundamental change, but the change we saw when the scheme was banded originally back in 2008-2009, and where it was rebanded a few years ago, were fairly fundamental changes, because it saw quite a considerable change in the incentives that were provided to the different technologies. Well, as you see from this slide here, we've got the RO is going to close to new generation from 2017. You might understand there might be some grace periods for those stations that can't make that deadline, but we're expecting it to close in 2017. All the activity that was happening under this scheme will move on towards the contract for different mechanism. But clearly, as we've already heard from our earlier speaker, there we have the carbon floor price, which is going to influence the way companies are making their investment decisions. And of course, we recently, in the last couple of months, saw announcements from Europe indicating the changes they have planned for carbon emissions, and also for renewable generation. And no doubt they'll have a keen interest in how this market evolves, and will no doubt look to change if it's not going if they think it's going in the right direction. The Feedin tariff, of course, is not included on this slide, because at this stage the government hasn't announced any major changes to the scheme. There will be some tinkering around the edges, but nothing fundamental is spoken about as yet. The next set of slides that I've got planned will run through in detail, or a little bit of detail, some of the outcomes, and touch a little bit on the costs that we've seen. So this is sort of the first slide on how the renewable sector has grown. What was perhaps lost in one of the earlier slides we saw earlier was it is a small component of the overall generation mix, but actually within the renewable sector, it is seeing quite considerable growth. So from 2007-8 time to 2012-13, for 5 years, we have seen more than a doubling in the output from renewable sources. It's worth flagging the main change that happened at the beginning of 2009-2010. You'll notice on these bars here the number of ROCs issued, the incentive for generation is exactly the same as the amount of, or relates directly to the amount of renewable generation. So up until 2008, 2009, generators got 1 watt for every megawatt hour. Now it varies according to technology, and so if you're on offshore wind, I'm sure you all know, you get 2 watts per megawatt hour of generation. And as we've seen the offshore generation pick up, as you will see in this slide, the number of ROCs the number of ROCs per megawatt hour issued to generating stations has changed. In this slide, we've got the last 4 or 5 years of generation, and you can see that the main growth has come in offshore wind. Onshore wind is also growing fairly significantly, and interestingly, in the 2012-13 year, load factors were down. So the amount of ROCs issued to onshore wind were more or less the same as they were in the previous year, but that was driven by load factor rather than uptake in capacity. The main growth, of course, as shown here, is in offshore wind, and that has been driven by the uptake in large offshore stations, particularly around the London Array in particular. Just by way of just to provide some background, if you're interested in any of the slides presented here, they are all available in our annual reports. We recently published 2 annual reports, one on the Feedin tariffs and one on the renewables obligation. And these charts have been largely taken from those sources. Interestingly, picking up on the point around fuel station, Drax is a station that is converted to biomass, and we have seen a very large uptake in fueled ROCs issued. But there will be a substitution effect. In 2012-2013, Tilbury was burning very heavily biomass. That station has closed, or is close to closing now. Did that slide say it was closing? Thereabouts, I can't remember. But it will be substituted from an increase in generation from Drax as it's converted one of its units under the RO and is planning to convert others under the CFE mechanism. Just to sort of begin to pick up on a theme about variability in the renewable sector. So this slide provides the annual perspective on a month-by-month position. You can see that the generation is very, very variable. And if you were to, I'm afraid I haven't been able to update this slide for the last couple of months. If you roll this slide forward to the last couple of months, December, January, and February have been particularly windy, which I'm sure we all noticed. Load factors for offshore wind in December 13 were over 60%. And on an average year, on an average month, it's around 40%. So all this wind that we've seen over the last few months has driven will drive a massive uptake in renewable generation, particularly offshore wind, but also onshore wind. I think what has been interesting, if you look at some of the detailed analysis of it, is that actually some of the onshore load factors are approaching that of the offshore technologies. We think that might have been because some of the offshore wind speeds are so high that they had to turn the offshore stations off. But by the time the wind comes onshore, it slows down a little, and so the onshore people are being able to take advantage of the increased wind. I think the important thing to flag is there's a lot of variability in generation by the different stations, but particularly as we've seen from the onshore and the offshore or wind. There are other technology types under the renewables obligation, but these are the key drivers. So I think that one of the things is variability in terms of the output, but there's also quite a variation in the where the technologies are employed. This is the UK picture around generation by type and rock tissue, and you can see, offshore is very sizable, onshore is also a very large chunk. Together they make up over 50% of the market, and fuel stations are important too. But if you compare that to Scotland, you'll see that in Scotland, pretty much 70% or so of the market is for onshore wind. So there's quite a variation between the different countries making up Great Britain for the different technology types. And if you have lots of onshore wind being taken up in Scotland, then obviously it needs to go somewhere, and transmission south is going to be critical if the growth continues. Moving on to just some general growth, because I want to begin to talk around the costs of the activity. I'm sure most of you will be aware that under the renewables obligation, there are effectively three mechanisms to comply. One, you present your certificates. Two, you buy out from your obligation. Or three, you do a mixture of the two. This chart shows how the level of the obligation and how the companies went about complying with their obligation. And you'll see that the lighter coloured green part has on the whole declined in area as we progress. And that is a reflection that the way the target has been set has been more accurately aligned with the growth in the market. So that the amount of obligation the companies have been buying out from has diminished over the last few years. But you might recall from one of the previous slides that I had that the number of ROCs issued per megawatt hour has increased. So I have to point you to, so if you look at the way the costs have changed over time, you see over the years have become invisible on your slide. Sorry about that. This is since 2008. This will be 2008, 2009. The final column will be 2012, 2013. You'll see in the early years, the support. When I say support, this is essentially the additional support per megawatt hour under the renewable obligation. Was reasonably flat from 2008, 2009 for the next 3 years. Then it fell under in the 2011-12 year as a consequence of the better alignment with the obligation. You see the lighter shaded area being smaller than in the previous years. But because, looking the line above, the amount of ROCs issued per megawatt hour has increased from just over 1.1 to nearly 1.25. The amount of support per megawatt hour with the RO scheme has now increased back to the levels it was at the end of the 2010 era, around £56 per megawatt hour. And this is obviously feeding through to consumers. Just to touch a little bit on the feeding tariff scheme, this I'm sure you've all picked up is essentially it lays out where most of the feeding tariff where most of the feeding tariff capacity is. About nearly 90% or so of it is in the PV arena. Just to give you an idea of the scale of the growth in the feeding tariff scheme, I've got another slide following this. When we set up the feeding tariff scheme, 5,000 PV units were transferred from the renewable obligation scheme onto the feeding tariff scheme. That was all the, if you like, the household PV units that were available at that time, 5,000. This last week we had 2,500 added to our system in a week. So the feeding tariff scheme has had a very significant impact on the uptake of PV in Great Britain. And I'm sure you're all aware, because the evidence here, the feeding tariff scheme itself has had a very bumpy ride. This slide essentially shows the monthly uptake in feeding tariff installations month by month. And you'll see that when the price of PV fell very sharply in the 2011-12 year, we saw a real rush in terms of the number of installations. And you can see that in a month-by-month period, we were seeing tens of thousands, 40,000 installations in a single month. The government imposed a number of changes, cut tariff rates in very quick fashion, and the numbers fell right back. And you'll see, obviously there were judicial reviews and so on, and depending on where those judicial reviews and so on were happening, it led to different surges in the uptake of the generation. But I think it's worth reflecting that when the scheme was set up, the feeding tariff scheme was set up, the amount of support for PV was 45p kilowatt hour. It's now 15p a kilowatt hour, and still the uptake is 2,500 installations a week. It's a very, very solid growth at very much achieve the support levels. I'm also struck that the 15p a kilowatt hour is compared more or less exactly with the strike price for offshore wind under CFD, £150 a megawatt hour. So we are seeing movement in this, and what's interesting is the price for PVs fallen by 66%. Offshore wind has not seen any kind of movement at all as far as I'm aware. This just gives you an idea of where the capacity is taken up by region. Essentially, anywhere south of the border with Scotland is dominated by PV. If you go north of the border, there is a bit more of a broader mix, particularly into wind and hydro. But there is also some PV up there. So just to conclude, some concluding thoughts. Renewable generation has increased very rapidly over the last 10 years. As I said in the slides I showed you, it doubled since 2008, 2009, and then if you went back previous years, you would have seen that it had doubled since about 2002 from there. There have been considerable cost implications for the sector, and one of my earlier slides showed that the way that these incentive structures are aligned does lead to some movements within the support structure, and can lead to increased prices being fed through to consumers. There is a strong variation between the regions for the uptake in renewable generation. Particularly in Scotland, there's a lot of onshore wind, and if you don't move down to England and Wales, there's more offshore wind and fueled generation. My final point that I'd like to draw out is that there are further plans changed. Capacities, so competition is being brought into the CFD mechanism. This will drive different uptake across the different technologies, and that is obviously something the government is going to have to watch if the target originally set at 30% of renewable generation from renewable sources by 2020 is going to be met. Thank you very much.